Hi class, today we're going to be looking at chapter 2. It's going to be a review of what we did last week. We're going to learn how to journalize transactions and put them in a journal correctly. So if you'll bear with me just a minute, I want to share my screen with you. And I know that I'm in the wrong screen here, so if you'll just bear with me for just a second till I can get this straightened out. Let me see. Take me just a second. Okay, I want to try to share my screen with you again, so hang tight with me. Okay, now you should be able to see Cengage. And what we're going to be looking at today is problem 2-4B. And in problem 2-4B, we're going to be the Valley Realty Company. And they have been in business for a while, so they've already got an unadjusted trial balance that was prepared on July 31st. And so what we want to do is we want to look at the dates that we're going to be working in this problem. And if you go right below this unadjusted trial balance for July 31st, you can see that we're going to be preparing transactions for the month of August. So what this means basically is we've been in business for a while, and these are the previous balances that were brought forward from July 31st into August the 1st. These balances are already in your general ledger. You'll remember we talked about the last time that we met, that was the ledger was a book of accounts where we post entries from the journal to that ledger. The journal is the book of original entries. And so what we did the last time we met is we put entries into the journal first, and then we copied them into the ledger. Well, the ledger already has some information in it from last period. This information came from the last period, so we're just going to start with a brand new period for this month, which is August the 1st. And so what we need to do is we need to record the transactions for August in the first book of original entry that we call the journal. So I'm going to start with my August 1st transaction, and I'm going to record it in the journal first. And then once we get all of our August transactions recorded into the journal, we're going to post to the ledger just like we did in a previous recording. And then we're going to prepare a new trial balance for this period of time, which will be August the 31st. So we're doing basically the same steps that we did in the last recording. You always start by recording the information in the accounting period that it belongs in. So we are going to be recording for the month of August, and we're going to put this information in the journal first. And then we're going to copy the information from the journal to the ledger. And once we have our ledger prepared, we'll copy from the ledger to the trial balance. Now, this problem is going to be rather lengthy, so I'm probably going to break it down into at least 2 recordings so you don't get so overwhelmed with everything. What I'm going to try to do in this recording is to record all of your entries in the journal first. And then I'll stop the recording and I'll prepare another video for you that shows us posting from the journal to the ledger. And then that should give us at least 2 videos for this particular problem that will be broken down a little bit shorter than they were the last time that we met. So on August the 1st, we are purchasing office supplies on account. Remember, every transaction has to have at least 2 accounts involved. In this transaction, we're buying office supplies. So one of our accounts is going to be office supplies. Now, what you have to remember that you should have learned in this chapter is that office supplies is an asset, and assets are increasing when we buy them. Because my office supplies account is an asset and it's increasing, I've got to record it on the debit side to show the increase in office supplies. In other words, office supplies is an asset account. And in my journal, I always record my debits first. So I'm going to choose the account, office supplies. I'm going to skip over my post reference because we don't do that until we have finished posting to the ledger. I'm going to put in my debit, which is an increase in the office supplies asset account for the amount that the office supplies cost us. They cost us $31.50. So I'm going to debit this account for $31.50. Every transaction has to have at least 2 accounts involved. My first account is office supplies. What you need to know in this transaction is whether office supplies is going up or down. When we buy office supplies, our office supplies is increasing because office supplies is an asset account. It will increase on the debit side. That's why I debited it here. I'm not through with August 1st transaction until I have at least 1 debit and 1 credit. So I know that my credits are on the second line of the transaction. In other words, always put your debit on the first line of the transaction like we did to office supplies. Read your transaction carefully. Answer some questions about this transaction. Did we pay cash for the office supplies? No. It says that we bought the office supplies on account. So we created a liability that we call accounts payable. Accounts payable, since it's a liability, is going up in this transaction because we now owe a creditor more money than we did before this transaction. So accounts payable is increasing. To increase a liability, we always have to increase it on the credit side. You'll remember from a previous recording, the first recording that we did in this chapter, we showed T account classifications. You have to know this in order to be able to understand what to write down here. So refer back to that video if you need some extra help, or look back at the Excel spreadsheet that I provided for that first video, which should show the T accounts and their account classifications. So this transaction is completed as far as journalizing the transaction. I have one debit, I have one credit, and my debits and my credits equal. Every transaction has to have at least one debit and at least one credit. And when you're through with the transactions, the total debits have to equal the total credits. On August the 2nd, we paid rent on the office for the month of $7,200. So I'm going to debit my rent expense account. And the reason that I'm debiting rent expense is because my expenses have increased. To increase an expense, you will debit. The amount of that debit is $7,200. Also, in this transaction, they told you that you paid the rent. So your cash account is decreasing. You have to know that cash is an asset. To decrease an asset, you put it on the credit side. On the August 3rd transaction, you receive cash from clients on account, $83,900. Anytime you receive cash, your cash is increasing. My cash is increasing, and because it's increasing and it's an asset, I'm going to debit that cash. I'm going to debit it for the amount that they told us that it increased by. We received cash of $83,900. Then look at the rest of that transaction to see what happened. It says we received cash from hint, hint, clients. Those are our customers that were on account. So you had already established an account receivable in a previous period of time. And those clients that we sent invoices to are paying us for those amounts that they owe us. So this is what we call accounts receivable. Accounts receivable is an asset account. My asset accounts receivable is going down. To make the asset go down, I'm going to have to credit it for $83,900. This is an example of a transaction where only the asset side of the accounting equation was affected. My cash increased, which was an asset. My accounts receivable decreased, which is an asset. Overall, because of this transaction, there was no change in the total of the assets. We just exchanged one asset for another. So transactions can affect only one side of the accounting equation, as this one did. But what you need to remember in this chapter is that every transaction has to have at least one debit and at least one credit. And when you're through with the transactions, the total debits must equal the total credits. So on August the 5th, we paid insurance premiums for $12,000. Your cash, which is an asset because it says we paid here, is going to be going down. So I know my cash, which is an asset, is going to be credited. But remember, in your journal, you always record your debits first. So what did I buy? I bought insurance. This insurance, when I buy it ahead of time, is called prepaid insurance, and all prepaid accounts are assets. Our prepaid insurance, which is an asset, is increasing because I bought insurance. I now have the right to use that insurance. The amount that I paid for that insurance was $12,000. So I'm going to debit my August 5th transaction for $12,000 to the prepaid insurance account because that insurance was paid for with cash. My cash is going down. So to decrease an asset, cash, we're going to credit it for $12,000. I have one debit to prepaid insurance. I have one credit to my cash. My total debits and my total credits equal, so I'm in balance for this transaction. I can move to the August 9th transaction. On August 9th, we returned a portion of office supplies that was purchased on August the 1st, receiving full credit for their cost of $400. In this situation, we've decided for whatever reason, we don't want to keep some of the assets, supplies that we purchased from the August 1st transaction. So we're going to return these to the store or the company that we bought the supplies from. We're going to send them back, in other words. So what they're going to do is the store is going to take back the supplies, and in return, they will give you credit toward that accounts payable that you originally owed on August the 1st. So what's happening here is our liabilities, accounts payable, is decreasing because accounts payable is a liability. When you decrease it, you got to put it on the debit side. In the journal, I always have to record my debits first. The amount of supplies that I took back was $400. That was the cost, and that has reduced the liability that we originally created in the August 1st transaction. So when we debit the liability, we're taking away from the liabilities. We are also, because we're returning supplies, reducing the amount of supplies that we have on hand. So our supplies, which is an asset, is going to be decreasing by $400. To decrease an asset, you would credit. So my liabilities went down and my assets went down. They both went down by the amount of $400. Our debits are $400, our credits are $400, our total debits are $400, our total credits are $400. So we're in balance. And we can move on to the August 17th transaction. On this transaction, they paid advertising expense of $8,000. We have, in effect, bought advertising. Advertising is an expense, so we're going to record the debit to the advertising expense in our journal first. So advertising expense, which is an expense account, is increasing in this case by the amount of advertising that we purchased. We bought $8,000 of advertising, and advertising is considered to be an expense. My expenses are increasing, and because I bought that advertising expense and I paid cash for that advertising expense, you see the word paid there, we're going to reduce our cash account. So cash is going to be reduced by the amount of $8,000. I have one debit to my advertising expense. I have one credit to my cash account for $8,000. Then I'm going to move on to my next transaction, which says that I have paid creditors on account, $13,750. If you're paying creditors on account, your accounts payable, which is a liability, is going down. To decrease the liability, we would debit the liability account to make it go down. The amount it's going down is by $13,750. My accounts payable could only go down if I had paid some money toward that account, and that's exactly what happened here. So my cash account, which is an asset, is going to be credited for $13,750. Then we're going to move to the next transaction, which is where we are paying miscellaneous expenses of $1,700. We've incurred an expense, so our miscellaneous expense is going to be debited. The amount that we paid for that miscellaneous expense is $1,700. So my debit is $1,700 to my miscellaneous expense. I'm going to credit my cash account for $1,700 because I paid for some miscellaneous expenses with my cash account. On August the 30th, we paid automobile expense of $2,500. So automobile expenses are going up. My automobile expense has to be debited, so it goes on the first line in the journal. My automobile expense was $2,500. I'm going to debit it for $2,500. And then they told us that we paid cash for those automobile expenses. See the word paid there, which should signal to you your cash is decreasing. To decrease an asset, you would credit. Now on August the 31st, the first one here, we discovered an error in computing a commission during July. So we made the error in July, but we discovered it in August. So what we have done here is we've had to correct that error. So because we recorded commissions as too much last period, we have to adjust the commissions account that we had paid to the salesperson. Notice it says we received cash from that salesperson. So we overpaid a salesperson a commission last month. We fix it this month, and we're fixing it by asking the salesperson to pay us back the amount of overpayment for that commission. We have received cash, so our cash is going to increase. Cash, which is an asset, will increase on the debit side. The amount of cash that we are going to be receiving from that salesperson to fix the error was $2,000. In other words, we overpaid a salesperson $2,000. Our credit is going to be to salary and commissions expense. Now, you might remember that I told you in the last recording that we did that our expenses are always going up. Well, I'm sorry, I forgot about this particular transaction here. This is one that is showing you that if you make an error, you can make your expenses go down. And so this is a situation where my expenses have to be decreased. To decrease an expense, you put it on the credit side. And so because we made an error in an overpayment of salaries last period, we've collected cash from that salesperson, and we're going to have to reduce our account salary and commissions expense to get it corrected. On the next 31st, we paid salaries and commissions for the month at $53,000. So now we're going to pay our salespeople salaries and commissions. It's an expense to us. Our expenses are going up by the amount that we're paying to them. And we're paying them $53,000. And then I'm going to credit my cash account because we're paying the salaries for $53,000. On the next transaction, which is the third 31st transaction, we recorded revenue earned and we sent bills or invoices to our clients. So because we haven't received any cash, we've got to record this as accounts receivable. We sent bills to our clients, so our accounts receivable has increased by $183,500. Accounts receivable is increasing by $183,500. Because they told us that we are recording revenue, our revenue account is going to be increasing. To increase revenue, we would credit. The name of our revenue account is fees earned, and the amount is $183,500. On the next transaction, which is the fourth 31st, we purchased land for a future building site at $75,000. We paid a down payment of $7,500 toward that building site, and then we gave a note payable for the remainder. So we bought land. This is an example of a compound transaction. It's going to have three parts to it. We purchased land. Our land, which is an asset, is increasing by the amount that we bought the land for, the purchase price or the cost of the land. It was purchased for $75,000. So land will be debited for $75,000. Always record your debits first. One credit will be to the cash account. The cash account is decreasing by the amount of the down payment, which was $7,500. Because cash is decreasing, we have to record that on the credit side. Notice our debits and our credits are not balanced. So we have one more account that we need to choose from, and that will be notes payable. Notice that in this transaction, it said that we gave a note payable for the remainder. So what you have to do is you have to figure out what that remainder is. We bought the land for $75,000. We paid down $7,500. Gotta put it in there right. 75,000 is what we purchased the land for. We're going to subtract out what we paid in cash. And what's remaining is $67,500 that we still owe for, because our notes payable is a liability. Our liabilities are increasing by $67,500. Now, when you get this entered in, if you add both credits together, it should equal your debit. So you'll know that you are in balance here. The next thing that we did is we withdrew cash for personal use, $1,000. So my drawing account, which is my withdrawal account, is increasing. To increase a drawing account, you would debit for the amount that you withdrew from the business. Your drawing account is increasing. But you'll remember from chapter 1 that when we get through with all of this, the drawing account will subtract from the total owner's equity. But when you're recording it in the journal, we got to show that the drawing went up, because the owner could withdraw some more a couple of days later, and we need to keep up with each one of those transactions separately. The amount the owner withdrew was in cash. Our cash would have been decreased. To decrease cash, you would credit it $4,000. And then we have the last journal entry. It says that we rented land that was purchased on August 31st to a local university for use as a parking lot during the football season. The football season is going to be from September to October to November, and they received an advance payment for that rent. Now, this one is a new transaction for you. So first of all, we're receiving cash because we rented out a parking space, a parking lot, to the university so that they can use that during their football season. Notice we're in August here when we received the money. We've received the money up front before we've actually earned that revenue. See, we're renting a land. We're renting the land that we originally purchased for a building site. We're just renting it to get some money. And so we're charging the university to have space in our parking lot while the university obviously is playing football during football season. So we're earning some revenues, what I'm trying to say to you. But the fact that the revenue has not been earned yet makes it an account that we call unearned revenue. I want you to write this down, class, in your notes somewhere. That unearned revenue is a liability account. What you've done is you've received money in advance before you have earned it. That makes it a liability, and it will remain a liability until you earn that revenue. So next month, we're going to earn some revenue. This month, we didn't earn any revenue. So we call it unearned revenue, and it's a liability account to us. but because we've received cash in advance before we've rented, we're going to debit cash for the amount that we have received, which was $5,000. We received the payment in advance before the revenue has been earned. Because we have not earned any revenue during this month, we have to call it unearned rent. Unearned rent is a liability. If we do not follow through and rent those parking lot to the university for the next 3 months, if we don't follow through on that, we have to pay that money back to the university. So right now it is called unearned revenue, which is a liability account to us. And that's the recording of all of your transactions. And as I promised you, I'm going to stop the recording. But before I do that, I'm going to check my work to see if there's anything I need to correct before we move on to the next portion of this. So what I've done is I have journalized my transactions for the month of August in my journal. Notice my page numbers on my journal. Page number 18 and page number 19 is what I've used. The next step in the process would be to take the information from page 18, starting with the office supplies, and post those to the ledger. But because that makes this a real long video to watch, I'm going to stop here. Make sure you know how to do these journal entries first. And then I'll prepare another video showing you how to finish up this particular problem. So I'm going to stop sharing this with you. I'm going to stop the recording.